All right. Good afternoon, all, and thanks for joining us this afternoon for the Vincent's property and lending update. We're really thankful to have you here today. Just a couple of housekeeping rules just before we get started. This is a live presentation, so please don't expect it to be perfect. But we certainly also want to make it an interactive one as well. So we're going to talk to you about a lot of different things involved in both the property and the lending world as of today. So we'd certainly welcome any questions or thoughts that you have along the way at the same time, and we'll do our best to try and respond to those. So please note you can upload those questions just via the chat box. So shoot them through to us, and then we'll do our best to respond accordingly. Before we get started, it wouldn't be a financial services webinar without a disclaimer. So look, what you're basically reading there is to say that none of what we're doing takes into consideration your personal circumstances. So it's important to note that the information provided today is opinion-based, and also we've done our research as well. So if you do want to know how it actually relates to you, then please reach out individually, and we'd be happy to support you with your inquiries as well. Now, just by way of introduction, so my name is Phil Ringuet, and I'm one of the directors here at Vincent's. I head up our lending solutions business. Our primary goal is we support the Vincent's clients and broader community with obtaining finance, whether it be for residential purposes, for business lending requirements, asset and equipment, and we also do some consulting work as well. And we also support the broader Vincent's base at the same time. We're also very lucky to have today as a special guest, so Joshua Coleman. So Josh, although having just founded Bywise Property, has essentially been in the property space for a number of years. Josh and I have worked together collaboratively at a number of different banks as well. He's held roles with Jones Lang LaSalle, also with the National Australia Bank. He is a registered valuer. He has a deep background in the property market as well, and he's very experienced to be providing an update for you as well.
That's very nice.
Yeah, so look, the things, just by way of agenda, so the things that we're looking at covering off today is Josh is going to talk through a bit of a background on the Southeast Queensland property market. He's going to talk through where he sees the opportunities and some potential threats as well, what the smart money is actually doing in the property space, and then I'll be providing a bit of a background on what's actually happening in lending markets. You know, there's always a lot of talk about what the banks are doing or what they're likely to do. So we want to try and dispel a few of those myths as well, and help you guys make some sound decisions on whatever it is you're trying to achieve in the next short to medium term as well. So without further ado, I'll pass on to Josh, and he can get stuck into his side of the presentation.
Beautiful. Okay, guys. So we've got a bit of an interesting one. There's sort of three key facets I want to go through with you today. First of all, being what's happening. The world at the moment is complicated and extremely interesting. It seems to be evolving by the day at the moment, not just relating to the virus and COVID, but also to do with economics and the property market itself. Second, I'll be touching on where to find value and opportunity in the space. Like everybody has a feeling there is opportunity to be had. And it's just important about understanding the circumstances that suit you and the market around you as to how to find that value. And then thirdly, when the smart money will move. So a lot of people talk about timing markets. Typically, timing markets is a fool's errand for the most part. I'm very honest about that. But I just want to give you guys a few cues to look out for. That'll be part of the strategy that people will take to hit that next step. Okie dokie, what do we got here? So, Southeast Queensland property market. Now, I'm going to touch on a few interesting things that are more or less a result of COVID. Obviously, there's a huge amount of things that make up these markets and the way these markets are operating. There are a few key things that are very interesting to note. This first graph here, I think, obviously is quite self-explanatory. That bottom dipping line there, I'm actually colorblind, but I think it's green. Is it green?
Yeah,
it's green. Okay. Yeah. That green line at the bottom there is actually showing you listing volumes. So properties available for sale at a point in time. And then those dark shaded pillars are showing you where the restrictions started, eased, and then started again, particularly for Victoria. You can see an incredible correlation there where listing volumes actually dropped over 50% between the March to May period. Now, listings always drop at that period. It's a quiet time of the year, and you can see that by the other 4 lines above it. But as you can see, the drop there was very significant. This is typically a correlation with confidence. Vendors deciding, will people buy my property? Will I get a good price for my property? And then thirdly, are buyers interested in buying property? We saw things start to tick up a bit sort of towards the end of financial year, where a bit of confidence came back. Virus looks like it was getting under control. Getting under control. But things obviously got a little bit more hairy when Victoria went back into lockdown. Now, confidence is not specifically being driven by COVID. And I think this graph here is actually telling, but also very interesting, because the government responded very quickly with some very heavy fiscal policy. Banks responded quickly with loan holidays across consumer lending as well as mortgages as well, commercial lending. And then also even our institutions, so insurance companies providing premium holidays. There's lots of involvement in this space, which I think actually has helped to maintain the levels we're seeing now. And anecdotally, this might look frightening in actual fact, but interestingly, it's actually benefiting the market. The main reason being that when demand dips, you want supply to dip with it. So that ideally those two can stay in parity, which keeps prices holding relatively strong. Which is what we're seeing for now. So the next thing I want to take you through is population. Now, this is an amazing graph. This was just released by the Australian Treasury. And most importantly, look at the end section of the graph, looking at the forecast of population into 2021. Now, that might look extremely scary, but the actual reality for this is it's almost exclusively to do with migration and mostly overseas immigration. There are some anecdotal levels of fertility changes through recession and things like that, talking about the birth death rates, etc. But the vast majority, more than 50% of that, is to do with the immigration. So it's about 150,000 person drop for that period of time. Now, although that looks scary, the reality of all of this is, what does this mean? And what I wanted to show you is actually the breakdown, which I think is really telling. If this was 200,000 people moving to Australia, permanent residents, cashed up, ready to buy property, we'd probably be panicking. That's the truth. We'd probably be like those ducks on the screen going for a fly in the opposite direction. But in actual fact, you can see the vast majority of those visa applications are actually temporary, and for the most part affect rental markets. So what we're seeing at the moment is a general softening in what you would call a high percentage rental market, which is typically your inner city unit markets, your mid-ring, cheaper, smaller house and land package style markets where the primary driver is rental. And that's an interesting thing to note, because when people talk doom and gloom with the realities of the population change, in actual fact, we're not expecting too much. And to that end, even some of the banks and a lot of the other major pundits, if you will, are actually maintaining that the reductions in mediums will be significantly less than originally predicted, which I think is a really interesting one to go through and to show people the facts about what actually matters with this. The numbers that came from Treasury with this is that between 80 and 85% of the migrants coming into the country will not buy in the short to medium term. They'll either be renting or even being provided accommodation if they're expats on skilled working visas or something along those lines. And to illustrate the fact of the changes in the rental market, this slide here is actually showing you the fluctuation in properties for lease or total rental listings from March to August. Now, those are some pretty incredible numbers. So South Bank at the top is actually South Bank in Melbourne, not South Bank in Brisbane. And of those 20 suburbs, only 2 of the suburbs are in Brisbane, which is Brisbane City and South Brisbane. So as I mentioned before, where the highest concentration of temporary or transient people are living, the highest percentage of rental compared to owner-occupied property is where we're seeing most of the increase. And naturally, this kind of increase in rental listings will blow out vacancy rates, which brings rentals down, and property that's predicated on rental income will likely see some fluctuations in values. And looking at this kind of information, that bottom quote here, which comes through from CoreLogic, last year, 84% of overseas migration flowed into the capital cities nationally, and 3/4 of that number went into Sydney and Melbourne, showing that the actual application to the Brisbane market is significantly less than what you're seeing down south. And that's also being reflected in a lot of the median numbers that are coming out.
Yeah. So Josh, if I just pause you on that. So, for the last few years, there's been a lot of talk around a glut of apartments, in Fortitude Valley, West End, and similar locations to that. If they aren't being taken up by a temporary resident, what's the likelihood of those still being absorbed between, I guess, now and 2023, at the point in time that they assume that they would almost all be taken up and would require more property?
Yeah, absolutely. Brisbane's been really interestingly placed for that. Our strata peak, or units, townhouses, etc., was a few years ago. And that was scary for developers. For the most part, those developers pivoted towards more owner-occupied property. So changing the mix of their development to really focus on owner-occupiers. And if you would have asked me that question prior to the fiscal policy from the government, particularly around home builder and things like that, things would be relatively glum, I would suggest. But overall, it's actually coming through and looking relatively okay. Now, when I say that, a lot of the unit stock in a lot of the more vacant markets. So for Brisbane, if we talk about that, we're talking about Hamilton, we're talking about West End, as Phil mentioned, parts of the city, even parts of Newstead, where vacancies are higher. We will expect those rents to compress and likely that demand to be relatively subdued. So I think the question as far as long-term absorption, yes, I think Brisbane's pretty well placed to do that. Certainly some of the southern states are far worse off in that regard. I hope that sort of answers your question.
Yes, definitely.
Looking at this graph, this chart rather, is interesting to show what the actual effects have been on markets in Australia. And one really interesting thing I'd like to draw your attention to is Canberra. So the third from the bottom, which is the top performer for the country as far as growth in values, or more importantly, not reductions in median values. But the interesting thing with this is a perfect illustration of confidence. Naturally, Canberra is with the vast majority of people in public service are confident with their employment as a rule, typically. And interestingly, that market was heading towards a unit glut more so than any other state. And their units are actually performing quite well, considering. So that's just a really great illustration of how confidence is playing a role. Confident people are still acting. And that's divided into relative levels of strata. So sort of between affordable, sort of your more middle tier upsizing segment and your premium segment. Sydney and Melbourne premium's taking the biggest hit. Units, normal infill units and housing is doing pretty well. Housing, interestingly, in Sydney and Melbourne is doing worse than inner city units at the moment. And for Brisbane overall, it's a similar sort of story. Brisbane's very balanced, considering. We've seen a 0.9 reduction in the last quarter, but still positive for the year. It's also important to note everybody's positive for the year with the exception of Perth. And that's mostly due to more economic concerns regarding replacing mining revenue and employment in that segment. But looking at those numbers there, it's clear to see Melbourne's doing the worst. Naturally, they're in a second lockdown. Sydney was doing probably equally as bad, but seems to be performing quite well now. Auction clearances are increasing. And Brisbane's doing really well. And one thing I want to overlay these last three slides with is a bit of anecdotes that I'm experiencing on the market at the moment. As Phil mentioned, I specialize in property acquisition, so helping people to buy property, to be wise when they buy property. And in Brisbane at the moment, the bottom end of the market is mental. And when I say the bottom end of the market, I mean existing homes, good land components within 20 kilometres of the CBD. I'm not talking about units, certainly not investor stock or even house and land package style product. We're seeing multiple offers at many open homes. First open homes, I had an anecdote 3 days ago of an acreage property that had 34 groups through on its first open home. Wow. At 1.1 million, and with 4 offers on the first weekend. And then the top end of the market is performing really well. There's been 5 sales over 5 million in the last 2 months. And that's purely concentrated in the northeast of Brisbane, so that Ascot, Peninsula, Hamilton, and some in Hawthorn as well. And the only thing where I'm seeing a little bit of pressure is in that upsizer market. So essentially that second period in life where people leverage again to try and buy that next big property for their family. And that's for a number of reasons that I'm sure Phil will explore at the end regarding lending. But mostly, again, I expect due to confidence. People just don't have the confidence to borrow big, take that risk on the market at the moment, which I think is mostly why we're seeing that. And that's actually an interesting opportunity that I'll go into.
Yeah, and look, just one question that I have around that as well, Josh. So, in that sort of sub 1.1 market, what is that demographic that you're actually seeing in that space? Who's attending those multiple offer transactions, auctions on the weekend? Who are those people as well?
Yeah, I mean, it's actually quite interesting. Obviously there's your typical professional couple with some young kids, typically under 10, usually in their late 30s, early mid 40s. But we're also seeing a fair bit of activity from the trade space, so people working in trade industries, particularly in that acreage style property. Interestingly, we're seeing a fair bit of people moving out into acreage property. We had a couple of inquiries. A client of mine was selling a property from Holland Park in Coorparoo, looking to buy an acreage property 20 k's from the south. So selling a small lot, relatively palatial home to then take on 6,000 square meters, a bit of space. And I think that's kind of a bit of a COVID knee jerk. I don't really expect that's going to be a long-term situation, with the exception of decentralized working. People that don't have to worry about the commute. And we're seeing a bit of that in Sydney and Melbourne as well. People who know their job is secure and perpetually flexible. That commute is less important on the list of priorities. Now, this is a really terrible summary, if I put it clearly. That graph is not great, but what I'm trying to illustrate to you is that confidence is low, but conveniently, demand and supply are equally as low. So the key output for that is that median values are mostly holding, which is really, really good. Oftentimes, if we didn't have the loan holidays, if we didn't have the fiscal policy going into the market at the moment with job seeker, job keeper, and home builder, we would expect to see that looking very different. A lot more people looking to sell property that they couldn't hold, people that are under pressure with losing tenants, etc. But that, because of the reaction of the government and the institutions, we're seeing that's remained quite balanced overall, which is a really incredible result considering.
Yeah, and so just when we're thinking about property prices as well, as a valuer, Josh, in the most simplistic terms,
here we go.
Why would, if you can just touch on what the valuation process roughly involves?
Yeah, great.
And why it would mean properties are stable for the foreseeable future.
Great question. So this is actually a really interesting one. So as most of you probably know, but I'll go through it. When we're valuing a property for a bank, the reality is comparable sales. So looking at history. So understanding in the last 6 months, what similar properties, and the key word there is similar, properties have sold. What did they sell for? What were the conditions? So essentially, did it sell in 30 days or did it sell in 300 days? Because if you were looking to use a comparable sale that took 300 days to sell, probably isn't a good indication of market. Now, sales volumes are low at the moment. So stacking up valuations with good quality, very recent sales is challenging and is involving valuers reaching out and speaking with agents who just sold property that might not necessarily be published. And overall, it's still going fine. There's obviously risks being applied by the banks by the val firms in their risk ratings. So essentially saying that there's, I think most of them going around at the moment is a 4 out of 5 on market risk. And what that essentially means is things are happening in the world right now, Australia as in domestically and internationally, which could affect markets overall. Now, that doesn't affect the valuation necessarily. It just might inform the bank on a particular location to go, okay, maybe this location's more high risk than another. And that's typically followed with high vacancy rental markets, house and land locations where there's huge supply pipelines and big developers, because naturally, if you're buying in stage 1 of 10, the developer has the prerogative over time to discount property to keep things moving, but that causes a haircut for everybody that bought property at the very beginning.
Sure.
So those risk factors will play a role. They're also taking more attention to high voltage power lines, flooding, etc., because naturally the security of the loan is critical. Most important thing they could come by. So I'm just going to move through these last things quickly so we can get to some questions after Phil has a chat. Great quote, real good cliche at the moment. Winston Churchill never let a good crisis go waste. I tell you that with a big dash of salt. The reality is that when you don't let it go to waste, doesn't mean be stupid. Doesn't mean move really quickly. It means be smart and be smarter than the other guy. The next slide here. So when you're looking for opportunity at the moment, first thing I recommend is looking for investments you can control. So things that aren't enormously exposed, that aren't reliant purely on market realities. So what I mean by that is buying property that is something now that will likely be better later. So potentially something with a higher value zoning, buying a low medium density zoning property or a future subdivision or something like that with good holding income. I can't stress that more highly. You know, a low vacancy rate location with a good holding income helps you to sail through this next period, particularly if things happen to get a little bit hairy. Invest for the long term, great cliche, but it's never more true than now than ever. And what I mean by that is to take advantage of opportunities that are non-market at the moment, and then carry that through the long term and get that benefit down the track. If you're taking short-term decisions in property, it's typically a mistake anyway, so it's just reiterating that for you. Capitalize on fear. I don't mean that in a mean way. I just mean there's people at the moment that are making knee-jerk reactions for either market or personal reasons, you know, unemployment or otherwise, and there is opportunity to take advantage of that segment, get a great price as at today. And when I mean that, I mean outperform the market so that you can actually either have a buffer or additional profit in the medium term. And then take the road less traveled. You know, the things have changed at the moment. The way people work has changed. The way people move has changed. The space requirements that people have changed. Big homes were off the cards 2 years ago. Big homes are back on the cards now. You know, large plots of land were off the cards 2 years ago. They're back now. So I really think about that, and also the unsung hero locations. Don't necessarily be scared by medium ring locations. As long as the access is good by road and public transport, you've got good infrastructure as far as shopping, lifestyle, etc. If you're 20 k's from the city, no problem. Just make sure you're getting something for your money. You don't want to pay an inner city price for an outer city property that you're getting nothing extra for. Yeah. Then the next one here. So when will the smart money make a move? I won't read these for you, but these are some real key things to look for. Smart money will always move when there's enough blue sky to understand the risk. At the moment, understanding the risk is challenging, and there's a huge amount of moving parts at the moment, particularly around the repealing fiscal policy, how that's going to happen, what's going to take place, repealing loan holidays, what's the process going to be there, what's the effect on the market, you know, understanding how all of the control mechanisms in monetary policy has changed as well. So with interest rates, what's the movement taking place there, and then also understanding the virus. Naturally, the virus is what's informing a lot of the confidence at the moment. The effects of Melbourne, as you saw at the beginning, were very palpable across the country. And that's the same for the rest of the world. If we start seeing second and third waves throughout New South Wales, Melbourne, other developing worlds, people's opinions will change. So understanding whether we got successful therapeutic treatments or vaccines will be critical. There's also a quote there from Tim at CoreLogic. It's a really interesting one. And I challenge any of you to have a think about that, because your opinion of that quote could shape your investment strategy moving forward for owner occupation and for investment. Because if people decentralize, people's priorities will shift. They'll move from access to CBD to where's my best lifestyle, where will I live my best life, and those are the markets that'll move. So it could literally U-turn the way the markets move. There was an anecdote that came out from JLL yesterday, but they did research of their landlords, and essentially 70% of participants are investing in improving their remote working capabilities. However, only 50% of them are significantly reducing their office reliance overall. So there will be a reduction, and the actual reduction was about 9%. So from about 92 square meters per 100 head to about 81 square meters per head. So it's not significant, but I actually personally, in my opinion, I think that'll shift over time. I expect that will probably tighten as companies take on less fixed costs over time, if it works for their productivity and for their staff. So I think that's mostly it from me, Phil.
Yeah, and look, I think that point that you just raised there as well, Josh, it's an interesting one, because the remote work force, or the agile workspace, has been around for a long time.
Yep.
And I think people have been starting to, want to, live where they want to live, where they can have the best possible lifestyle experience. Yep. And they're happy to travel into work, especially those who have come from interstate, where the typical journey happens to be 45 minutes to an hour into the CBD.
Or 2 hours if you're in Sydney.
Yeah, whereas in Brisbane, you find yourself in some pretty reasonable locations for a lot less travel time.
Absolutely.
As well. So perhaps we just see that come forward a little bit as well.
Absolutely. And it's just people's priorities shifting. And if they're happy to sit an extra 5 minutes in the car, pay $300,000 less and have an 800 square meter block, that'll come to front of mind.
Yes, especially with the possibility of being trapped with a couple of kids.
Yes.
In a lockdown, it does make sense to have some more space.
It does.
Right. So look, I'm going to just jump into the lending side now. So just a quick reminder as well. Josh has done a really good job of explaining everything there. But if you do want to ask some questions, then just feel free to enter them into the chat box, and we'll do our best to cover them off.
And also anything if I haven't covered it. If you're looking at got any questions about commercial property, anything more macro, happy to take those questions.
Definitely. So this slide that I just wanted to share with you today. My role is I'll be talking to you about what's actually happening within the lending or the banking environments currently, what's on offer in terms of support that has come out to date, and potentially what's still coming through the pipeline. I think I'd just overlay my presentation with the theme being one of cautious optimism as well. And I think Josh's presentation could relate to that as well. So, whilst jumping into it, Josh has mentioned that there's been a significant amount of initiatives that have come out quickly, and they've certainly done a really good job. So if you're in business or you're an individual, you may have been insulated to a certain extent because the government and the banking sector has really come quickly to our aid. So it started off with a number of different initiatives. We saw some state-based initiatives, which are currently closed, where businesses had access to extremely cheap funding alternatives. There are also the federally supportive SME guarantee schemes that were rolled out by the federal government with the support of the major banks and some of the smaller banks as well. Those still continue to play out, and we're starting to see the second phase of those take off in October as well, which will open up businesses' ability to borrow for both expansion and a range of different alternatives as well. Deferrals. I don't think there's been anyone who hasn't talked about a deferral or the potential of one. Some people have used them quite strategically. Others, have definitely used them, to their advantage in a time of need as well. And we're starting to see all of those roll off. So I can give you some context as to, what that's meaning as well. And then I just want to talk to you about what's actually happening in lending markets in terms of what we're seeing, which generally happens to be our clients trying to restructure. So they've really given some thought to the current environment. Most of them have realised that they actually need to take the next step and continue planning. Life goes on, as they say, and that they actually do need to look at doing things as well. So I can talk you through a little bit of that at the same time. Okay, so I just wanted to touch on what's still out there in terms of support. So the key one is really around the COVID-19 SME scheme. So this has been rolled out by the banks, and the actual take-up has not been as high as many had expected. We've actually done a number of applications where we've practically got to a formal approval and the clients actually haven't taken the money. So we thought the clients would pick this up pretty easily. The clients can borrow up to 250 for working capital, and working capital is largely defined as your operational expenses within your business. The rates were relatively cheap at 4.5%, and it was an unsecured liability as well. So this has kicked into gear, but I guess it might have been a bit restrictive in terms of what people are looking to do. So we're starting to see the next phase of this package roll out. We're hoping to see that in October. There's not a lot of detail around it, but we believe it's going to be up to about $1 million. And businesses will actually be able to utilize that, not just for working capital expenses, but to actually grow their business, to drive new initiatives as well. And hopefully that will drive a bit of confidence back in the market, because it's going to see people be employed again, them embark on marketing initiatives and a whole range of positive exercises in that small to medium enterprise space as well.
So do you expect that could be segmented, as in whether they target that pretty broad? Or do you think they might look to target that towards the most hit tourism, hospitality, things like that?
Oh, look, it definitely is a first in best dressed initiative as well. So it's not a finite, it's not infinite bucket of money. It is finite. So if you do think that you need it, then you should be exploring those options as well. But look, the banks are really trying to make this as accessible to people as possible. And generally, you would qualify as long as your arrangements have been managed within their contracted terms prior. Your statutory obligations, things like tax, are up to date. You'll be able to access that funding, where appropriate as well. So what are the banks actually doing as well? So I just wanted to touch on what's on offer. So, there's effectively, if you want to break the banks down into two markets, we've got our banks And then we got our non-bank lenders, which are our niche lenders. All of them have reacted very quickly. They've also reacted responsibly as well. A lot of them have offered their clients immediate deferrals. So when I say SME in this slide, I mean small to medium enterprises, which you would just consider as a small business.
Yep.
But essentially, they've given a range of deferrals which flow through to business loans, residential loans, asset finance, credit cards as well. And they've done this by effectively making available their hardship clauses to their broader client base as well. So whilst it's called deferrals, that's essentially what you're accessing as well. And it's been available to anyone who can demonstrate that they've been affected by COVID-19. And, at the end of the day, who hasn't?
It was also important, obviously, with APRA jumping on that, to allow the banks to do this. APRA made the changes required with provisioning and everything else to allow them to treat these deferrals not necessarily as deferrals in their book, which is important.
That's right. And look, when we say deferrals, it's not it's effectively a holiday. So you are still accruing interest. You're just not repaying your loan for a period of time as well. These are still certainly available. So if they are in need, I'd strongly suggest you do reach out to your own financial institution or your broker for support on how to navigate that environment. But what we are starting to see now is them starting to come off. So people who were issued these deferrals in March, April and May, they're all starting to roll off those. So the market's going to be tested coming into October and November because people are actually going to need to look at making their loan repayments all over again. So the market's been...
At a higher amount.
Yes and no. Potentially some people have seen their loan terms extended as well.
Interesting.
So, there's going to be that financial burden of I need to make my loan repayments again. And how am I going to manage those expenses in this new environment, especially if I'm still being impacted by COVID, whether it be via a wage reduction, I'm on JobKeeper or I'm off JobKeeper. We're going to see a few things start to happen there as well. And it's going to be our first test as well.
And that's starting about the end of this month, those reviews, isn't it?
Yeah, so we're starting to see them happen. For commercial clients, we're also hearing as well that they are starting annual review processes for clients who are currently in deferral. So what they're looking at doing is they're looking at regrading their clients. So most commercial borrowers that are assigned a grade, and which relates to the strength of themselves as an applicant. What they're looking at doing is basically reassessing those. What the outcome of that does is it will determine pricing, fees, the amount that they can borrow against a particular security as well. And it may have some impacts on loan covenants, but the reality is loan covenants have largely gone out the window of late.
Oh, that's interesting. I was going to ask you that.
You'd hate to be the bank that has to enforce one right now, especially post a Royal Commission as well. It would be extremely difficult. All right. So if I look at what the opportunities are out there, typically we are actually in our lowest ever cost of funding environment right now. So we're seeing rates from as low as 2.19% for residential borrowers. We're seeing commercial rates, well and truly in the twos as well. We have these conversations with people who are currently, they've got commercial properties and they're tenants, they're paying rent. And when we're talking to them about what their repayments would be like if their rate was, 2.84%, all of a sudden they're starting to think, well, geez, maybe it's smarter to actually own a property. So we are seeing a bit of a resurgence in that owner-occupier market. And also for those business owners who have self-managed super funds, we're starting to see a bit of a pickup in that space in inquiry as well. So the commercial property space, whilst not great from a commercial investment standpoint, because there are some headwinds, as an owner-occupier, just due to funding costs itself, there are certainly some opportunities that are quite attractive there as well.
Agreed.
We've seen a lot of momentum in the asset finance space. So I talk about asset finance as equipment, so motor vehicles, plant, office fit outs, all the technology, all those sorts of things. Rates are again at all-time lows in that space, and we've really seen a big pickup with the instant asset write-off. Now, the instant asset write-off was to continue it was to end at the end of the financial year. But for those who don't know, that's been extended all the way through to December this year, where it effectively allows you to potentially speak to your accountant, write off the value of an asset that you actually acquire in your business.
That's up to
150,000. Yeah. So a good way to claim a tax deduction, and you can certainly borrow to acquire that asset. And it's very purposeful initiative by the government. So it's to, drive people back into the market, acquiring goods, supporting local businesses, as well as a big thing. Now, cashbacks, sorry, this is a little bit of an older slide. So they were as high as $4,000. They're generally sitting about $2,000 now. But what that means is just with the effort of moving banks and actually saving money, the banks are actually willing to pay you a couple of $1,000s
Free money
for your effort. It essentially is free money. So for a bit of time and effort, and the reality is hopefully your broker or your banker supports you throughout that whole transaction. So it is quite simple.
If not, call this bloke.
Yeah, you can just pick up the additional cash. We've also seen the banks start to loosen some of their credit policies to a certain extent. We've seen interest only come back into the market as well. And we've also seen commercial terms go from around about that 5 to 15 year space to as much as 25 years as well. And what that actually does is if you can stretch your loan term out from 5 or 10 years to 25 years, obviously that takes a lot of pressure off your capacity to repay that loan. It's reducing your monthly commitment as well. So we are seeing a lot of people restructure and refinance. So refinance for lower rates and restructure to lower the costs associated with their investments as well. And the point that Josh raised as well, we almost shockingly, because, you pick up the paper, you read those articles, you're hearing 40%, 20%, 10%. It gets lower every month in terms of what property values are going to decline by. We just haven't seen it. So they've been stable. Josh has provided the rationale behind that as well. So if you are thinking about utilizing equity in your property, now probably is a better time than most. We don't know what the market will do in the near future. We don't have a crystal ball. So if you'd like to unlock it, now's possibly a good time to use equity to consolidate debt, acquire other property or other investments as well.
And one important thing I'd just mention on that as well is whenever you see these comments online, particularly on the news platforms, etc. First of all, they're referring to medians. So medians is not necessarily you, not necessarily your property or necessarily your location. And every market's performing differently by quartile. And essentially a median can be very heavily affected by a huge compression in premium property, for example. And the alternative is going the other way as well. So it really depends what kind of asset you have. Some are performing, like Phil said, really surprisingly well. Some are pretty subdued, but overall, as those graphs showed you, it's pretty balanced.
That's exactly right. So look, just in terms of what's actually happening in the banking space, so you do have some understanding of what the changes are. We probably saw a case of the banks starting to play the man instead of the ball, if I can use that cricket analogy. So there was a wholesale shift to bulk changes in credit policy, and we're starting to see those unwind now. But look, essentially what we did see was additional verification of income sources. So, where in the past we might have been able to use 80% of your bonus, we were only able to use 60%. We might have had to verify it over a longer period of time or just request some additional documentation. ATO liability certainly became an issue. So we needed to see that you were managing those in line with your agreements. Now, there's a big difference between an actual ATO liability being overdue and one that's been simply deferred. So it's made really understanding that. The deferrals has been an issue. So if your loan is currently under a deferral arrangement, well, then you're not going to really be able to move banks. You'd need to wait until that ceases. And then essentially once you make one repayment and show that you're not in any sort of financial hardship, then you can look at restructuring all your borrowing obligations. The regulators have certainly played a part. So they've placed a lot of pressure on the financial institutions to get money out of the door and actually support business as well, which has been good in a time of need. COVID impact statements, many of you would have heard that as well. And that's as much as just checking in and saying, have you been affected by COVID? And if so, how? Or do you anticipate any further changes to your ability to earn income or to your financial position? So it's just essentially answering those questions. And last and not least, but LVR restrictions, so loan to value ratio restrictions. We've seen some banks scrutinize particular postcodes. We've seen them have a look at some security classes. When I say that, I mean apartments versus townhouses versus houses versus rural property.
Industrial, commercial.
All those sorts of things. So we've seen them LVRs drop down. We've seen them go back up. But luckily, we've got access to the broader market base, so we can generally balance that out quite nicely. Now, there certainly are some industries that do receive a little bit more scrutiny than others right now as well. And look, they're really no-brainers. I mean, these are industries that have been pretty hard hit by COVID, things like tourism, hospitality, retail in particular. So if you are in those industries, do expect that you are going to have to provide some additional information. You're really going to have to address those COVID impact statements as well. Borrowing money is certainly not impossible. If you do need access to funding, you certainly will get it, because good, high quality borrowers are still going to get funding as well, and they will get it reasonably easily. They may have to wait a little bit longer because the banks are taking a little bit of time right now, but you will certainly be able to get access to that funding when required. All right, look, that's pretty much it from me today. So, as I mentioned, if you'd like to ask any questions, it's probably been a bit of a longer presentation.
So much fun stuff to talk about.
Yeah. So, look, please feel free to shoot through any questions that you might have. We'll give it a couple of seconds. It is on delay right now.
While we're waiting for a question, there's one really important thing that people should understand at the moment is no one has a vested interest in things going bad. There seems to be a lot of bears out there, and I think a bear once upon a time meant cautious. I think it's the reality, whereas at the moment it seems like a bull in the opposite direction. But the reality is at the moment, no one has that interest. Banks are their balance sheet is hugely secured to property, for one thing, about 60% from what I understand. Government is the same. It's a huge wealth pool that's going to provide people with retirement, and no one wants to mess with that. So I think you'll continue to see support mechanisms coming through over time, and existing support mechanisms being held just to make sure that people do get through this as unscathed as possible. There will be some blood. Things like this are always going to cause that. But the reality is people will be pushing in the same direction on this, and trying to support things as best they can.
Yeah. All right. So we just had a couple of questions come through. So looks like one for me. So I'll just read out the question. So banks are taking a long time to complete refinancing and restructuring loans. Any comment on why this may be? Yeah, look, it's a great question. And look, it's not a level playing field. Some banks have been more affected than others. There's definitely banks that we know are taking upwards of 25 business days to even look at an application. But there's also banks that are taking as little as 1 and will have your formal approval within 2. So it's really about understanding what your current need is. And as a broker, we're looking to basically place you to that right space. So if you said to me, I've got a 7-day finance clause or 14-day finance clause, it just eliminates a number of different players in that space. The reason why, though, that they have actually slowed down significantly is because of the deferrals. The bank staff have been largely displaced. When COVID hit initially, banks who had external call centers, say in the Philippines or in India, lost a significant amount of their workforce, in the thousands, essentially. So what that meant was they actually needed to displace their frontline staff to actually get on the phones and really help support clients with the deferral process as well. So that took clients away from the credit areas, from the frontline lending areas as well. And it's essentially just slowed down the process. Now, some banks have been very efficient in implementing processes that can actually help them get through that. Some banks are still stuck right in the thick of it. Some banks are certainly open for business and can turn around transactions very quickly. So, the key thing is it's not a level playing field. It's also not their fault. It's an unprecedented event. And they've generally done their best to support clients where possible. Yeah.
It's also true as well. I mean, some of you might not know, but most of the major consumer banks are domiciled in Melbourne. Most of their head offices are down there that are closed. I know that certainly some of the majors have been closed for months. And as you could imagine, managing and controlling a workforce of thousands from homes who've never worked from home before is challenging, which I'd say is the flow on.
Yeah. That's right. I've also got another question here. This one's probably for you, Josh. So if I was intending to move from, say, Brisbane to the coast, is it best to sell and buy at the same time, oversell then rent at your destination?
Okay, this is a great question. Now, this is a really interesting one that's evolved over time. If you would have asked me this question in March, I would have told you short property is the way to be. If you're going from one to another, you'd rather be short than long, would have been my answer. Now that's evolving at a considerably fast rate. And particularly if you're looking at going to the coast, that market is doing, depending on what you're buying, I would premise this with, if you're buying a house on the coast, not in a multi-stage redevelopment, with a decent land component, ideally infill, I think that market's going to do pretty well. And that's going to be for a number of reasons. One, because a lot of people are thinking like you at the moment, and not just in Brisbane, not just in Queensland. There's a lot of people. I saw an estimate a couple of days ago. They're expecting at least 30,000 immediate moves from Victoria, ideally either into central Queensland or into Brisbane, Gold Coast, immediately post-lockdown. Now, that's an anecdote that was in this article. It was to do with a survey they completed. This is by realestate.com, by the way, if you want to try and find it. So I think the reality could be, I would probably say, depending on your risk appetite and your opinion on markets in the short term, would determine whether you remained short, long, or balanced being out of one into another. But just bearing in mind, subject to sale clauses are going to be challenging, particularly if you want to buy a high demand property. Because there's obviously risk implied with selling your property, and there's risk to the vendor of taking your offer in and missing out on somebody else's. So probably, in my opinion, if it was me, I'd probably remain balanced rather than going long and heavy in property, particularly if there's a significant debt component. If you're all cash, you've got a great opinion of the market, you're buying a good quality asset, I'd be less concerned. I hope that answers your question.
Yeah. All right, good stuff. Well, look, I think it's we've gone on for a while now. So I know, Josh, really appreciate you coming along today. You've been really thorough and giving us some really some good things to consider, in terms of our decision-making process as well. So look, I'd like to thank you all for attending this afternoon. If you have any further questions, please feel free to reach out to us. You can find us on the Vincent's website as well. We can also share our contact details post this as well. So we look forward to catching up with a few of you post this event. Thanks again.
Thanks, guys.